Hey everyone and welcome back. My name is Hamish Hodder and it is a sunny day in Melbourne, which is very surprising actually, considering we're only a couple of weeks away from winter, but it's a beautiful day outside. I have the doors open, so you might hear some birds in the background, but some of you OG subscribers would know all about the chirping birds in the background of my video. Hint, don't go watch some of my older videos. They're terrible. But yes, if there's any birds or dogs barking in the background, that is exactly why, but it is a great day and I thought I would have the doors open because, of course, we're doing one of the greatest analysis of all time. The greatest analysis of all time? No, not really, but it's a great company that we're looking at. Of course, it's McDonald's because you can see it on screen, and McDonald's is a company that every single person out there knows about. There's not a single person who doesn't know what McDonald's is, and there's probably not a single person who hasn't ever had McDonald's. It's kind of a rite of passage to have eaten at McDonald's at least once in your lifetime. I don't know if that's true, but this is a great company, and there's no doubt that this has been a massive stock market success over the past 50, 60, 70 years, and it's been a massive success in terms of the underlying business. So it begs the question, does this business fit my very specific, very conservative criteria of investing in businesses? So that's what we're going to get into in today's video. If you're not a subscriber and you're seeing me for the first time and this is a video that you enjoy, then you may want to consider becoming a subscriber. We do these every single week, and we also bring out videos talking about how to go through the analysis process from start to finish, whether that's looking at the underlying business or calculating intrinsic value. Everything that you could possibly need to start investing in businesses is on my channel, so consider becoming a subscriber. But essentially in today's video, we're going to start by going through the underlying business, looking at what its business model is, and we'll talk about some of its competition. And then I want to bring up one key business indicator that you need to be focusing on if you're going to be investing in McDonald's, or for that matter, in any kind of restaurant business that has a franchised model. So we'll talk a little bit about what that key factor is and why it's so important to the success of these kinds of businesses. Then what we'll do is we'll jump into looking at the economic moat. We'll talk about whether or not this company, McDonald's, has a long-term competitive advantage. And spoiler alert, it clearly does. But in this video, I'm going to break down why it does and how you can identify it as I've identified it. Because in a company like McDonald's, it's very obvious that it has a branding moat, but in other companies, it's not necessarily obvious that it does have some kind of intrinsic characteristic that's giving it an advantage over other companies. So I'm going to talk about how I've identified that in McDonald's and how you can apply that to other businesses. Then we'll talk about management. Management is super important in stock analysis because these are the people who are making decisions for us. They're making decisions about where to use their profit, where to put their cash flow. Are they going to pay out a dividend? Are they going to take on some debt? Are they going to buy back stock? Or are they going to reinvest in the business? And what combination of those things are they going to do? So we'll talk about whether or not management has integrity and whether or not they are showing that they are skillful at investing within the business and paying down their debts. And of course, towards the end of the video, we'll do what everyone is looking forward to, which is an intrinsic valuation. How much cash do I think we can get out of McDonald's over the next 10 years and beyond? And therefore, how much would we be willing to pay for it? And more importantly than the final number that I come up with, or the range at which I come up with for intrinsic value, I'm going to show you why I reached that conclusion so that you can use that process in your own analysis of whether you're looking at McDonald's or any other business. So without further ado, let's just jump straight into the video. So McDonald's, as you would know, is a fast food restaurant chain that was founded in the United States in 1940. So it's a really, really old company, and they actually have the most outlets of any restaurant business in the entire world. They have 38,000 different McDonald's locations, which is mind-blowing if you think about how many locations that really is. But then again, if you think about how often you see a McDonald's when you're driving down the street, whether you're in Australia, the US, or any country basically, the frequency at which you see McDonald's, it doesn't surprise me that there is so many out there. And it's amazing that they've been able to build this massive empire. And part of the reason why they've been able to build that empire is because of their business model. These are not company-owned restaurants. These are franchised restaurants, which means that the company itself does not own each of those individual restaurants. So some of you out there might be wondering, how does a franchise business model work? What am I buying when I make an investment in McDonald's Corporation if they don't own each of those restaurants. So what McDonald's owns is they own the real estate below all of those locations, or at least below most of those locations. And then what they do is they find individual franchisees, which are basically just entrepreneurs who want to start a business, but want to start a McDonald's restaurant specifically. They find these people and they set them up with a restaurant. So what the franchisee does is they pay McDonald's Corporation a startup fee, which in Australia at the moment is somewhere between $1 and $3 million in terms of startup fees. Then McDonald's will build the restaurant, and often McDonald's does actually own not only the real estate underneath the property, but actually the building as well, but they don't own the contents and they don't own the operations of that restaurant. And then the franchisee, because they don't own the real estate, has to pay rental payments. They have to pay lease payments to McDonald's. So far, McDonald's, the company, is making money through the startup fees, which are $1 to $3 million. They're making money through the rental payments that the franchisee is paying in order to use that land. And then they are also paying a royalty. So a small portion of each of the McDonald's restaurants' revenue goes directly to the McDonald's company. And that is how they make their money for 93% of all of those 38,000 restaurants. And it was that franchise business model which allowed McDonald's Corporation to expand and scale up their business so quickly. However, the restaurant industry is still super competitive, and they still face fierce competition from many other new restaurant chains and existing restaurant chains, as well as many other categories of places where people can go and eat. If we look to McDonald's in just the United States, their comparable store sales did increase by 2.5% in 2018. However, their comparable guest count was down 2.2%, which essentially just means that there was less people coming through the doors of McDonald's restaurants. And while they were able to increase their comparable store sales overall, which means that they're increasing their prices or increasing the amount that each customer is spending at McDonald's and overall increasing their sales, the long-term driver of growth of a restaurant industry, of a restaurant business, is their ability to increase the amount of traffic, to have more people coming through the door. And this is something that McDonald's is suffering from in the short term, at least in the US. So that brings me to talking about that one key business indicator that I said was super important for these franchise types of restaurant businesses. And what it's called is system-wide sales. And this is something that you need to be aware of if you're going to be investing in the restaurant industry. System-wide sales includes sales at all restaurants, including total franchise restaurant sales. McDonald's only collects a small portion of a franchise's restaurant revenue as a royalty, so their total franchise revenue is not included on the income statement. However, McDonald's management believe that this is a good indication of the health of the McDonald's company and its brand. So rather than looking to McDonald's Corporation's revenue as a sign of health in this company, you should be looking at system-wide sales, which is the total sales of all of their restaurants, even the franchised ones which they don't own and they only get a portion of. But those total sales growing over time will indicate that their restaurants are more popular over time. So this figure is actually much more important than McDonald's Corporation's revenue, which will be on their income statement. By the way, guys, if you're interested in learning more about the four-step strategy that I'm using in this video and that I use to analyze all stocks, I actually created a free 20-minute training on my website. The video explains the simple four-step process that I've used to consistently outperform the market, and also talks about some of the biggest mistakes that value investors make when analyzing businesses in the market. So if you're interested in that free 20-minute training video, then you can get it with the first link in the description below. But moving on, let's talk about the economic moat. Let's talk about if there's any kind of intrinsic characteristics about this business that is giving it an advantage over its competition. So of course, at first we want to do a qualitative analysis, which is where we come up with a hypothesis based on our understanding of the business. And one of the key qualitative moats that I could identify in this business is their branding moat. The McDonald's brand and reputation is highly recognizable, and because of the uniform nature of their menu and their experience and their service, whenever someone goes to a McDonald's restaurant, they know exactly what they're going to experience. They know what they can order, they know relatively how much it's going to be, and they know how long it's going to take in order for that order to be fulfilled. And this has created a powerful brand around McDonald's. And Traditionally, I would say that a branding moat is one that is classified as narrow because customers can go to different restaurants over time and shifting consumer preferences can erode these moats. However, every now and then there is an exception to the rule. And McDonald's is certainly one of those companies that is an exception to the rule. And after doing our qualitative analysis, I can hypothesize that they do have a wide economic moat. But now we need to go and do a quantitative analysis. We need to look at the numbers to see if the numbers support our contention. From the table, you can see that I've added system-wide sales because it is a much better representation of the health of the company. And you can see that they've been growing their system-wide sales at somewhere between 1 and 2% per year over the long term. In terms of their actual sales, it has been declining because they've been making a shift away from company-owned restaurants to more franchised restaurants. Now, franchised restaurants bring in less revenue, but they have significantly higher margins. So a decrease in these sales does not necessarily mean that they are being less profitable. And from EPS, you can see that over the long term, they've still been able to increase their earnings per share at 7% per year compounded. And the reason for that is because they've had relatively flat net income, and then they've used a significant amount of that net income to buy back stock, which has reduced the number of shares outstanding. Equity is not available to measure because they actually have negative equity, meaning they have more debt than assets, which is a massive concern for us as a shareholder and something we want to look into further. Free cash flow has been relatively flat over the long term, and owner's earnings, which is a derivative of free cash flow, is pretty much the same. It's been very flat over the long term, and actually more recently it's been significantly negative, except for in the past year where they were up 11%. And those numbers aren't outstanding, but they clearly have some kind of advantage in their branding and in some of their other economic moats as well. But we will need to watch that US comparable store sales to see if their business continues to be eroded in the US, as we've seen that less people are coming to their US stores, at least over the past couple years. The next part of our analysis is to look at management. And I mentioned earlier that we look at management's integrity, their investing ability, and their debt management. But for the sake of time, we're just going to zoom in on their effectiveness at investing within the business. McDonald's return on invested capital has been very good over the long term, and it has also been very consistent. It's many times been above 15% and has consistently been above 12% over the past 10 years. And this is a great sign. However, they aren't maintaining a high ROIC while investing more money. They've been investing the exact same amount of money and producing the exact same amount of free cash flow. So it's been very flat, but we should not expect that they can compound their money internally at this rate because they're not reinvesting any money. And if they were to invest more money, we don't know whether or not the ROIC would stay flat and their earnings would go up, or whether or not their earnings would go down and the ROIC would go down with it. So that finally brings us to doing an intrinsic valuation. And to do an intrinsic valuation, we first need to work out how much cash was returned to shareholders in 2018, and then what is the rate of growth that cash flow is going to grow at into the future, and therefore we can estimate how much is the total amount of cash that we could expect to get back from this company over the long term. I estimated cash flow for owners to be 4.9 billion by taking their cash flow from operations of 7 billion and subtracting maintenance capital expenditures, which was their capital expenditures related to existing restaurants. And that gave us a cash flow for owners figure of 4.9 billion. I then came up with a number of different models, but for one of the specific models, I used a growth rate of 5%. And this was at the top end of the range that McDonald's gave as guidance for their long-term revenue growth. So assuming that their margins stay consistent over time, and I expect that their margins will in fact actually increase because of automation, but let's just be conservative and assume the margins will stay the same, then the top end of that growth rate should come down into their free cash flow, which would be a 5% growth rate. Using a 5% growth rate and that starting cash flow for owners number of 4.9 billion, we get an intrinsic value for the entire company of $112 billion. Then using a 22% discount rate, which is 8 times our money over the next 10 years, we get a whole business buy price of $32 billion. And that equates to a per share buy price of $42.50. Now, $50 per share is significantly lower than the current $200 per share price tag. And I know there is a lot of you out there screaming at me, telling me, Hamish, you are too conservative. But I want to explain myself as to why I think that it has come out this way. So as you saw, I was targeting a 22% return, which is a huge return and something that you really can't expect to get out of a company like McDonald's. And let me explain. McDonald's, as we just went through, is a pretty great business. It's a solid brand, it's got a solid branding moat around it, and their earnings have been very consistent over time, which means that there is a lot of investors that have high confidence in the ability of this business to pay a dividend and to buy back stock. And as a result, a lot of investors are willing to pay a premium. And that is why the stock is priced so high. In fact, over the past 5 years, the stock's earnings really hasn't changed. Sorry, over the past 10 years, the stock's earnings really hasn't increased on a net income basis, but the stock price is up 300%. So over that time, they've just increased the price, but the value of the entire business as a whole really hasn't changed too much. And on a per share basis, it's changed a little bit because of those share buybacks, but they also have more debt. So you could use that as an offset and say that it is a very similar valued business as it was 10 years ago, but the price is 300% higher than it was back then. Now, this business may have performed very well for its shareholders over the past 10 years, but I would not have invested in it because I'm looking for a very specific type of business that can generate me a huge return, not just 10 to 12% per year over the long term. I'm looking for businesses that can generate me a much higher return, or at least safely a much higher return. So if they underperform my expectations, I will still make at least an above average return. So I hope you guys enjoyed this one. And as I said earlier in the video, if you're new around here and you enjoy these kinds of videos, then consider becoming a subscriber. I make these videos every single week and we have a ton of other videos on the channel. Let me know your thoughts on McDonald's down in the comment section below. But for now, guys, I'll see you in the next video.